So I'm going to, and VTF. I'm associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure. I really want to see what's going on with Snap. Gonna get a chart. Snap getting smoked on those numbers? Ooh, adjusted EBITDA numbers, no good. For second quarter. Expectations. Yeah, it doesn't look all bad. Yes, that snapped right back. Ba-dum-bum. Woo! Little trading humor for you guys. Little trading humor. Don't all laugh yourself out the room. I know I'm a pretty funny guy. Yeah, Snap coming back a little bit. Oh boy. Oh boy, oh boy, oh boy. Let's talk about the market. I'm exhausted. Man, I said it yesterday. I probably said it the day before that. We're probably getting tired of hearing it. These last couple of weeks here in April have been some of the most difficult trading I honestly ever remember. Like, ever remember. These last 2 weeks. This has just been so hard. There's been almost kind of no rhyme or reason to it. The market doesn't seem to listen to technicals. Just when it looks like we're breaking down on Monday, we break up. Just when the buying pressure is looking incredible on Tuesday, and honestly even yesterday, despite Netflix with the way that most things held up. And then we get Tesla there, which maybe you think could be the cherry on top after the Netflix disaster, and then this happens. I mean, this was so bad, this price action. I know that we really were just in neutral territory. Neutral territory means you can go up or you can go down. But with the smaller time frame upside pressure, I thought we were lined up to really kind of give some upside follow through. Pat had a really good morning note today that I hope people read. Not to go over the whole thing again because we discussed it in the morning meeting, but I thought that this was a great note here that kind of gave your Morgan Stanley and Mike Wilson kind of macro bear case here on the market, but also kind of gave the, where is he? Where are you, Marco? There he is. But also kind of gave, I think, JP Morgan, Marco Kolanovic's bull case here. And honestly, I almost feel like this bull case can fit within this bear case because this bull case is a little bit more smaller time frame where we're talking about investor sentiment basically at 30-year lows, really low investor positioning, which is something that I'm aware of, or that we're aware of because we talk about it all the time. As volatility decreases, which looked like it was happening 2 days ago when the VVIX made new lows for the year. That brings in new systematic strategy buying, which we know has been under positioned in the market. And like I've mentioned a couple times, we always want to take seasonality with a grain of salt. But this is, I think, typically the strongest week of the year historically. So you kind of had all that lined up coming into today's trading session. And again, your bull argument here is that all of the interest rates increases from the Fed are really priced in at this point, and that we are at or near or have achieved potential max inflation. And with the market being a forward-looking mechanism, then maybe price can kind of begin to improve. You know, that was really your bull case, and just kind of saying it in a nutshell. The bear case here was also laid out very well today in Pat's note, talking about the destruction that inflation can bring, on how, yeah, on the one hand it can bring nominal revenue growth, but on the other hand it acts as a compressor to margins. So margins decrease for these companies as people spend less, which gets exacerbated by commodity prices being as high as they are from Russia and Ukraine. And at the end of the day, the stock market does run on the profits of these companies. So even the labor market, which maybe you can view as a good thing, that more people are working and more people are making money, that also is really, I loved how this note described labor as an input cost, because that's really what it is. So I think that there's a world here where both of these cases can live within each other, where we could potentially see stronger, smaller time frame price action within the confines of maybe bigger picture bearish price action. I still have kind of been of the thought process that a lot of those forces kind of counterweigh each other a little bit, where, yeah, like the note says, you get that nominal revenue growth increase from inflation moving up. At the same time, corporate profits can potentially go down. So I have kind of been of the thought process here, honestly, for most of the year, for one way or another, that we could be in a real market environment where we just get like a whole lot of sideways volatility, kind of exactly like what we've been experiencing here, without any real breakout higher to all new time highs, but not necessarily having your 30 to 40% downside bear market either. That's kind of been my consistent thought process. The price action has honestly confirmed that for most of this year. But most of this year, these driving moves have been so big that as a team, we've been able to do a fantastic job with a couple of things. Recognizing particularly when the big rallies should come in. This low, this low, this low. We caught as a team extremely well. Being prepared for like a rotation into value and a rotation into energy was another thing that as a team that we've been able to be really on point with. So even though this year has been very volatile and kind of broadly sideways to down, we've been able to kind of, I think, as a team, really capture these moves and really have an on-point thought process until these last 2 weeks. These last 2 weeks, which in some ways, these 2 weeks have kind of been the tightest of the year, right? Like, almost at any point this year, we were having big down moves, big up move, big down move, big up move, big down move, big up move, big down move. And in these last 2 weeks, it's just been like, one day we're going to go to the top of the range, next day we're going to go to the bottom of the range, the next day we're going to go to the top of the range and look like we want to break out, the next day we're going to go to the bottom of the range and look like we're going to want to break down. We're bullish, we're bearish, we're bullish, no, we're bearish. So that's really kind of been the MO of this market on the smaller time frames, and it's just been super difficult. I was totally wrong today. I was totally wrong today. And again, we talked about this in the morning meeting, like, and in yesterday's meeting too. Like, this is the importance of having your price triggers, because for some of the ideas that I had today, like a potential long in some of these growth stocks, like Path potentially breaking yesterday's high. I was talking about this AI potentially breaking yesterday's high. There's a couple of trades that were on my radar, even though they actually tried to run in the first 6 minutes of the day, as did the market for about 6 minutes today before it totally died. They never actually really triggered or trigger entries. So it's kind of like no harm, no foul if you didn't get caught in it, as long as, like Rich was saying earlier, as long as you didn't cheat on the entries, which I honestly would have understood if you tried to cheat in like a Path or an AI with this opening, the price action, this looked pretty good. I guess the volume wasn't really confirming. AI though, both these were looking pretty good. A lot of those growth stocks were looking like they wanted to kind of take off this morning. And honestly, 5 minutes into the day, I was a little bit nervous looking at the NASDAQ about how extended it was, but I was like, we got this. We got this. You know, once again, the team is on point for energy did not look good, which, you know, my thought process had been yesterday, actually a little bit of a rotation out of energy, at least on a small time frame, and back into growth and technology. I kind of pulled back on that a little bit for today's trading session, where it was more like maybe we could see just like choppier price action, no real movement on like your XLE and these energy type stocks and those material type names that have been so strong, while getting a move in, you know, kind of these growth type stocks, because we know that the funds are under positioned. And you know, I do think it's notable from what I've seen historically that when funds are under positioned and they start to get worried about missing on a rally, they usually chase the most highest beta stuff to try to kind of make up return and capture more alpha that way. So if you do have under positioned funds really start to rotate their money back into the market, that could be a way that it happens. And then all of a sudden here, you know, at this pivot low here, 945, then it looked like things were flipping. It kind of looked like your fear trade was back on. You know, we still had these consumer staples being super strong, though I do think that they actually finished in the red today. We still had our consumer staples being super strong this morning. Energy was kind of rallying, and you could see, you know, I called it out. I wanted to see the Qs pivot here. They failed, but they could not lose this opening low, and they could not lose 344. Once we lost the opening low, I communicated here to the team that we know from a probability perspective that when you get an opening momentum move like this with 100% retracement after the ADMA is caught up to lows, that the probability of a new high coming in on the day becomes very low. So honestly, once this happened, once we got to here, I was disappointed. Because I had the thesis for follow through. I was ready with my buy triggers to do some buying today. Luckily, never really got entered into anything, so you know, didn't lose kind of any new money today, type of situation. But once we really started to lose these lows, and especially here, you know, we tried to bounce back through that 344 that I was communicating, and that was important to me, really more kind of based on the 15-minute chart, because you had your ADMA on the 15 catching up to what was a little bit of an area yesterday and the day before that, like flipping back and forth between support and resistance. So I really wanted to see, as this ADMA on the 15 caught up and this tail came in, that this was an actual real low. Once this low broke on this candle here at 1045, that's when we know that our 15-minute chart becomes really important. I threw in the towel on this day. Now, even as I threw the towel in on this day, I was throwing the towel in on my thesis that we could see some real follow-through from this market between the buying pressure that we saw over the course of the last couple of days, plus Tesla potentially helping kind of market sentiment for these growthy type stocks. Even as I threw in the towel on not seeing that upper price action, if anybody wanted to bet me a close at 334 today for the Qs, or a close at you know, below 440 today in the SPYs, I would have lost a lot of money on that bet. This downtrend today on the intraday was sick. It really was. I mean, this is like a straight 45-degree angle downtrend that lasted the entire day with barely and even an intraday bounce. You know, barely an intraday bounce. We had that one little bounce in the beginning of the day when the market was trying to respect its 15-minute chart, and then nothing. You know, one little bounce here at 115, baby bounce at 230, and then some volatility in your last half hour. What about Snap? Which way is it now? Is it up? Is it green? I thought those numbers didn't look bad. Let's go. Let's go, Snap. Save us, Snap. That last earnings season on Snap was so crazy, right? When it got wrecked on Facebook and then came all the way back up. Anyway, I digress. Yeah, just just really, really kind of crazy price action. And I know that the Qs were weaker yesterday. That's the one I have up right now because of Netflix. So they, for 2 days ago, closed right at the key level that we needed them to get above. They never got above, but the SPYs were certainly above. The IWM was certainly above. And in one trading day, we lost multiple key levels. We lost the, what was it, 445 that I kept talking about that we need to close above for the market to get back to kind of more neutral territory. We lost 440, which has been a key inflection point overall for the market. And the SPYs here closed like literally at this broader, bigger picture support of this sloppy price action consolidation that we've been in over the course of the last 2 weeks. So just, guys, really, really hard price action. I've been in this business now for a long time. And honestly, I really feel like these last 2 weeks of price action have been some of the most difficult that I've ever seen. It's like the market decided today that yesterday the market decides that it doesn't care about the potential of yield curve inversions and recessions and things like that, and it's all priced in. Today the market decides all of a sudden it cares about it and wants to try to create a little bit of a bid in defensive things like the dollar and treasuries, but even defensive stocks and value stocks couldn't hold up today. So it's just this price action has been really, really difficult. But again, what I need to reemphasize in a time like this is the importance of a couple really key things, because honestly, these key things are even more important in difficult environments than they are in great environments. But you always need to be able to implement them. But when you got an easy environment, the market will kind of let you get away with making some mistakes here or there. In this type of environment, the market will not let you get away with the mistakes. You need to have game plans in place. You need to be focused on your risk management and your money management. That's always first and foremost the key to success, big picture, in the trading business. And secondly, you need to have a game plan for how you want to execute these trades. So like, again, the stuff that I had on the radar here, probably by the end of the day here, literally every single position that I discussed in the morning meeting today either never triggered or didn't work. And that, again, is just the importance of knowing what your execution spot is that you want to be entering at, because you think that can be the catalyst to further price action. So if it never triggers, it never triggers. The path, 1998. Did path touch 1998 today? No, it didn't. Should you have lost money in path today, even though we discussed in the morning meeting as a potential long? No, you shouldn't have, because it didn't actually trigger. AI, we talked about a buy through 1982. Should you have lost money today? No, it didn't. It never triggered. Only by 2 cents, but it never triggered. So the fact that the idea failed doesn't really matter, because you never got triggered in to begin with, so you don't actually lose money. That's the importance of having that kind of game plan established. Even as these things may have looked great in the first 5 minutes, they never actually triggered. A couple of these other ones may be more difficult. ExxonMobil today, we discussed, that maybe this could get some rotation. It didn't. At the end of the day, it didn't. This is one that you definitely could have lost money in by buying right at the open, kind of versus yesterday's high, is what we discussed. And if you lost your risk in it, then you have to be okay with that, because we're in the risk-taking business. I'm the first person to talk about how I actually hate putting on that initial risk, because there is a chance that this happens. You buy ExxonMobil and the thing just immediately fails and you get stopped out and you lost your risk. But you still have to put risk on, or you're never going to be able to make money, and you have to be comfortable with the risk that you're putting on, because you will have days like today where just kind of everything fails. Guys, we had every reason to believe, I think, technically, that we could get some upside follow through on this market today based off of the price action that we've seen over the course of the last couple of days. In the back of my brain, I can't help but think that Tesla didn't trade as well as it should have, and that almost should have been a signal. And even immediately from the moment that the report came out, I felt it didn't trade as well as it should have. It was almost like the stock wanted to be heavy, but the numbers were so good that it was kind of up almost in spite of itself. So maybe that was like a little bit of a signal that I can't help have in the back of my brain, that maybe I could have done a better job recognizing that that could have been a signal there. But that's still so hard, because I mean, at the end of the day here, Tesla is one of your few green names. And by the way, we did call out, you know, kind of a good little closing kind of upside scalp in Tesla. I don't know if anybody was able to make a couple bucks in that. I did also call Apple as a buyback through 160 here at 10 after 3. So I don't know if anybody was able to capture that. But outside of that, honestly, for the most of this midday price action, look at this. Look at this trend in the spot. Look at this IWM. What are our percentages today? IWM closed down 2.5%. Qs here are down 2%. SPYs are down 1.5%. The IWM was up like 1.5% at highs today, I think. And I'm just going off memory. I'm not sitting here doing the math right now. But that means we had a 4% intraday straight 45-degree angle, 5-minute downtrend in the IWM today. That's kind of crazy. And it wasn't really on, not that I saw, on anything new. I know that the Fed spoke today, and I'll be honest, maybe this was a mistake. When the Fed members were speaking around 11 o'clock today, I kind of was ignoring it, which is a little bit unlike me, because usually I'm actually overanalyzing every little piece of every information to try to put it in the puzzle. But I am stuck on the thought that the Fed interest rates at this point are a little bit priced in. So I didn't think they were going to say anything new, and that the interest rates are priced in. I saw that the one non-voting member, I don't remember who it was, maybe someone can remind me, said, there's even a chance that we could do a 1% interest rate hike or whatever it is at one of our meetings, but probably not. Yeah, thanks. Is that pronounced Daly or Dally? I don't know. I don't know how to pronounce anybody's names because I don't hear them. I only read them. But anyway, I know that there was a little bit of negative commentary coming out on the day there, but look what the TLT did. TLT actually doesn't look terrible here. We called out this day as maybe a day that you could look to buy, though the entry on it was difficult and didn't close well. The follow through happened the next day anyway. This actually is not bad price action if you're looking for a further snapback in the TLT. The fact that we made a potential higher low here and closing with like a little bit of a hammer shaped type candle here could have us set to get above the high from 2 days ago, get above the 80 MA. But it's never always perfect, the kind of correlation between how bonds trade and how the equity market trades. It's kind of a thing that evolves. So like, there's a bunch of different ways you can kind of start thinking about how they can affect each other, right? So on the one hand, you could look at the TLT selling off the way it did this month and go, wow, that's a destabilizing effect for the market. That is, really fear is usually represented in buying of bonds. It was almost like a different kind of fear, where it was like a race to the exit because interest rates are supposed to be going up this month. But you could look at that in a couple of ways. You could say, and this is what I'm talking about how the effect of bonds is like a constantly evolving process on the equity market. You can have these bonds really move lower, and you can say, oh, well, look, all the money's coming out of the bond market. It's got to go somewhere. Maybe it's going into the equity market. Or you can see bonds going down like this, and you can say, oh, my God, this could have a huge destabilizing effect on all markets, on the equity market. This could be a really bearish sign. And as a matter of fact, we have in the past, in some of the more recent faster down moves that we've kind of seen in the bond market, that this one here might be taking the cake. We saw the equity market begin to sell off on this as a result of it, as a result of kind of that destabilizing effect. It's similar to inflation, right? I'm sure everyone remembers it was just like a couple of months ago where everyone was so fearful about inflation, and that's the reason why the market's going down. And then into this rally here in the second half of March, it's, oh yeah, you know, inflation isn't that bad. Stocks are a safety play in inflation. So because of the inflation, that's why the equity market's kind of going up. You know, they always want to apply a reason kind of behind everything, and it is a constantly evolving narrative that does have some truth to both aspects of the story, and it's something that we have to kind of consistently pay attention to over time. So yeah, I don't know. I guess that's kind of the point there. But at the end of the day, this is a really negative, engulfing candlestick. This is a really bearish candle, and I'm saying that 2 days after we had a candle here that looked so good, that broke out through all the levels that we needed and closed really well. 2 days later, the complete opposite. I think NAMCAP here likened today to this day, which I remember this day. I remember this day very well, this March 3rd, because this was actually another trading session similar to today, where I got completely thrown off course in my own kind of a approach to the market. Oh, it was you, Justin? My bad. Because it was the same thing here. It was like, okay, we're recapturing 440, which was like a key level at that time. We're recapturing 440, and I think that there was like Iranian news that came out pre-market. I think I was short the SPYs actually as a hedge, and I got stopped out like pretty much at the high, like at 441 on that day. And it was that Iranian oil headline that came out that kind of ripped the market higher, and we're clearing key technical levels. I got stopped out of my SPY hedge. I'm ready for my longs to pay me, and then we kind of closed on lows, and it was a false breakout that then led to the closing low of the year for the S&P. In some ways, this day does feel similar. Like we were just looking at getting back above this 445 kind of area here. We just got back above these moving averages. Things are just looking good over the course of the last couple of days, and we have like this false breakout higher that leads to us closing all the way at these lows. Today felt like it almost could be a day one where we technically really break down further, though I almost have to question my own kind of market logic at this point, just because of the way that the price action has acted over the course of the last 2 weeks. We have consistently, and this, by the way, is a hallmark of a range-bound market. This has just been very tight. Is that when you're in a range-bound market, a lot of times when things look best is when you go down. A lot of times when things look worse is when you actually go up. So certainly tricky. It looks like we're going lower. We are coming into some big earnings reports over the course of the next week or two, which will absolutely have a big effect on the market, just like it did on the last earnings season. Yeah, we'll see. Right now, things are looking pretty bearish to me, but I can't help but take it with a grain of salt. From Bullard, bond market now is not looking like a safe place to be. That's a great headline. That's a great headline. So where's the safe place to be, Bullard? Please tell me where the safe place to be is. I'd like to know. I don't know. All right, gang. That's all I've got from kind of my end on things here. I hope everybody was able to kind of stay safe on their trading session today. And I am happy to answer any questions that you guys might have. I'm just noticing PS's question out of the corner of my eye. I know I usually start at the top. I did not notice that the Q's poked above the 20-day. I assume that you're talking about the simple. I don't have that on one of my charts right now. I should, the 20 simple. I'd be curious to know not just if it poked above the 20-day, but the slope of the 20-day. Which I'm assuming that the slope of the 20-day, just by looking at this price action, is down but flattish. So when you have a moving average like the 20-day or the 200-day, it applies for that too, just it's a little bit of a bigger time horizon. It's the slope of the moving average is really important. So if the 20-day is sloping down, a lot of times that's exactly when you'll see what you're talking about, which is a poke above it, leading to kind of a failure, because the slope of the moving average really represents the essence of trend for that time frame. But yeah, then we lost that key 345 very quickly. Anyway, let me scroll back up here. Let me scroll back up and answer some questions from Robert. Here's my thought process about market rotation play today. SPY was extended at the open, which could lead into fading the gap situation, at least during the opening price action, and that could lead into positive money flow for the XLE. However, the SPY held at the open, pushed higher into 450, and in the meantime, the XLE went down to your S1 level, support 1 level, which was the previous day's high around 88.50, Exxon Mobil inside day pattern. And once the SPY rejected at 450, which was negative flow, which was leading, you're 100% on point with your thought process here, Robert, until everything died. That brought Exxon back above 88.50, which is where you got long. All based on my money flow speculation. What do you think? No, I think it's a really good thought process. You know what we spoke about this morning in the morning meeting today. First of all, the expectation was broadly higher, which turned out to be wrong. But the expectation that we had based on the morning meeting today was broadly higher. I thought there was a higher probability that was going to happen in more tech growth type areas today, though you can't help but make room for the possibility that could happen in value and particularly in energy because of the strength that it's seen all year, and it's been a great trade for us. They generally haven't all traded together, but there have been some really strong trading sessions that we've had where we've kind of seen everything go up in unison. So that goes back to my thought process from yesterday's morning meeting, actually, where I was actually looking for rotation to come out of energy and into growth. Today I adjusted it to maybe energy goes sideways and we can still kind of catch that bid in growth. No matter how you look at it, it's wrong. It didn't work out. But the logic behind the thought process, I think, is what's most important. And then you want your technicals to provide you the confirmation of the execution of the logic, which is kind of the one thing that I'm talking about. So I think that your logic here is totally on point, and you're doing the right things. You're watching the market. I don't know. The only thing I might take issue with is you're looking at rotation between SPYs and energy. I would almost be looking more at Qs and energy, because you're talking about how you're expecting them to kind of trade opposite a little bit. So you're talking about how, like, I thought that because the gap was so big in the SPYs, maybe they could be weak early and energy would be strong early. But then when I saw the opposite taking place, that this was acting really strong and the XLE acted weak right at the open and fully filled its gap, and then you saw it kind of flip. I don't think I would look at the SPYs as much for that, because like you heard me say actually probably a bunch of times in the first hour of the trading session, because it's really been true, the reason why the S&P hasn't gone into a bear market when the NASDAQ and the Russell has is that the S&P, we haven't seen, like, in those brutal bear markets, correlations really begin to increase and everything sells all together. Like, that's what we saw in COVID. They just sold everything. Even the stay-at-home plays like a Netflix, which eventually was your strongest stuff, even that stuff got sold initially. That's what, like, real brutal bear markets look like. The year 2022, we haven't really seen that. There's always been at least some sort of money rotation kind of going on. There's always been something that's been strong, and it's tended to be energy and value type stocks overall. So yeah, I lost a little bit of my kind of train of thought there on where I was going with that. But those are the things that you want to be paying attention to, and it's why you shouldn't be looking at the SPYs as much when you're looking at that XLE money flow kind of idea. I think you should be looking more at the Qs and maybe the IWM, because the SPYs always seem to be the benefactor of wherever the flow is. So if the XLE all of a sudden is trading really well, that's actually going to help the SPYs hold up. But the XLE trading really well is never going to help the Qs hold up. You know what I mean? But look, overall, I think that your thought process was right. I actually think that if you were able to execute this Exxon back on the way up through 88.50, that's a phenomenal job from an execution perspective. Because even though we had Chevron, Exxon, and then like PBF and RRC on our morning game plan radar for today, the execution on them was really difficult with how this XLE like totally filled its gap this morning. I know Oxy was on the list for some people also, and Oxy actually held in pretty well. Yeah, honestly, if you were patient enough because you were watching the market going up and saying, I don't want to buy Exxon because of that in the beginning, and then you actually took this trade back through here, dude, that's phenomenal execution. It really is. That's a really, really good job. So give yourself a pat on the back, even if at the end of the day you weren't able to really make anything on it. So good job, Robert. From Brandon, was the real misread this morning that we are in a downtrend overall and had a 2% gap up on the Qs into resistance and into the moving average? Hindsight really seems that the highest probability trade was to try to short early. Yeah. So in hindsight, sure. But, you know, what I'm always talking about looking for is confirmation across our indices. And what I see this morning is that I've got the Qs gapping to resistance and gapping to that 21 EMA. And yes, I did warn everybody this morning that the common gap was very large. So the first thing I said this morning in the morning meeting was, I'm not pounding the buy button the second the market opens. I want to see the price action satisfy its extension, and then I can look for those longs, right? We did specifically say that in regards to your comment on the gap. So that's another reason why I hope that no one actually got hurt today, because things never really properly, you know, triggered for us to be doing most of this buying. But as far as recognizing a large gap up into resistance, which is, by the way, a trading 101 short, I didn't see that confirmation across the indices. You got that in the Qs, but you don't have it in the SPYs, which are clearing above certain levels, though we did talk about 450. You can see it, guys, right here on my idea list here. SPY resistance levels 445, 450, 460. You know, we did talk about SPY 450 actually as resistance 2, so we traded into resistance 2 here and totally failed at it. But I got the SPYs clearing up above this last level. I got this great buying pressure here. I've got the IWM that's now cleared above 200 and 202. That's clearing above resistance levels. And I thought that the only reason why the Qs weren't the same, the only reason why the Qs weren't gapping up even higher was because of the price action resulting from Netflix yesterday. So I was actually kind of taking the fact that we were gapping into resistance on the Qs as something that wasn't as important as it would be normally, because I thought it was only happening strictly because of Netflix. So that's why I wasn't excited about that short trade today. But yeah, you know, in hindsight, trading 101, common gap into resistance, press the short button. Would have worked today. But even, you know, still though, look at this opening Q price action. This is a bull flag. And I was like, oh, guys, be careful. Like, the bull flag might not hold because of how extended we are. We might have a deeper price correction and then get a pivot and go. That's what I thought was going to happen. I didn't think that this bull flag was going to work perfectly and then give continuation. I thought that it was going to fail, pull back, shake out your very short time frame momentum traders who like to look at 2-minute charts or whatever, and then pivot and then go. And we did fail on the bull flag, but we never pivoted and went. So that was that. Yeah, we did have the airlines on the radar today as well. I know, you know, we talked about on an intraday here, like this buy on AAL off this 80 EMA. This was a very similar setup to the plug trade from 2 days ago, and the whichever one that was yesterday, I don't remember. PG PG, right? And PG from 2 days ago. No, I don't remember. But you guys know exactly what I'm talking about because we discussed it enough here over the course of the last couple of days. So I think someone on the team here took that when it got called out. You got your risk covered, and then unfortunately it failed. Jets looked pretty good here with this consolidation, the ADMA catching up. So this sector ended up green, but this price action, very hard to make money buying any of these airlines actually long intraday today, unless you bought UAL very early. Very hard to actually make money intraday along the airlines today, though they were on our radar and they were relatively strong, and the earnings reports there were decent. DWAC breaking down, finally. This thing's got a long way to go. Long way to go. I'm assuming that the borrow is still stupid expensive on this thing. It's so dangerous to be short it. But I think it's got a long way to go. Where's our snap? All over the place. Back to small green here. From Arnold. And I actually really want to do a deeper dive into the snap earnings report, because I think that if the earnings report is just okay and it holds up here, that's actually a decent signal for some of these growth type stocks. From Arnold, in days like today, what are your thoughts about getting long into SQQQ versus shorting TQQQ or the actual Qs? I prefer, amongst everything that you just listed, generally, to short TQQQ so I can have time decay on my side, as opposed to buying SQQQ where I fight the time decay. It depends a little bit on if there's a cost to borrow, which TQQQ is easy to borrow. I don't know if they're going to hit you on an overnight locate cost on that or not, but not on an intraday at least. So I don't really like buying the SQQQ. Maybe if it's just a pure day trade, my preference is to short TQQQ if I've got conviction on the market going down, so I can have decay on my side. Yeah, David, it's definitely been tough recently. From Jerry here, yeah, WeWork, my best name on the day, still closed like garbage. What is the best way to enter when it's a 9Z name like We today? It opened a few minutes after 9:30. You had to chase price a bit above the trigger, but you still got your 1-to-1. Yeah, I don't have a perfect answer for you on that one, Jerry. So basically what Jerry's talking about here is the fact that New York Stock Exchange stocks don't open up at 9:30. All NASDAQ stocks, because it's computerized, open up exactly at 9:30. New York Stock Exchange stocks open up whenever the floor specialist, or whatever they call it, actually opens up the stock for trading on that day. It happens manually, so it happens at sometime at 9:30 or thereafter. Usually happens sometimes between 9:30 and like 9:31 and 30 seconds. I've seen stocks open as late as like 9:33, 9:34 because they're trying to settle the imbalances and kind of get the market made and have it set to go. It's tricky because it's only at the opening on New York that they settle the imbalance and have the New York bids and offers actually hit the market. So you can cheat by buying like at 9:30 before it's open in New York, but you could get hurt because it could open with that imbalance, and that balance hits, or just the bids and offers hit on NYSE and it immediately drives it back down, and you never would have gotten triggered in otherwise. Or other times it just kind of causes you to miss the trade. So I don't really have a good answer. If you paid for depth in New York Stock Exchange, which I actually did that forever until like 4 months ago, I dropped it. I didn't want to pay the extra cost anymore. Most of you guys are not paying for depth in most of the ECNs. You're paying for depth in NASDAQ, and that's it. I forever was still paying for New York Stock Exchange and ARCA on top of NASDAQ, but I dropped BATS, EDGX, and EDGE a long time ago. I I finally dropped New York Stock Exchange recently because I just wasn't using it and just paying for it every month, and I probably hadn't used it in 3 years and was just paying for it. Stupid. But if you pay for your depth on New York Stock Exchange, you can see where the bids and offers are set to open and cross based on where the stock is actually trading. And a lot of times it's still not helpful information, but sometimes it is if you're seeing a really big bid or offer that's on New York before New York opens, because it's going to cross and you're going to be able to have a general idea on it opening above your price that you want it to or not. So that's kind of the only way there that you can get a real signal on if you should buy early or wait. And again, I don't think it's worth paying the cost for New York Stock Exchange depth to be able to see it, because it's kind of a rare situation that you're talking about here. So I don't really have a fantastic answer that can overly help you. So, sorry. I have a 5 o'clock meeting, but I can make them wait a little bit because I'm the one running the meeting. One new thing from Powell today was he always said inflation is transitory and will come down. Today he said because of deglobalization maybe is not transitory. Quote, less globalization could mean higher inflation and lower productivity. Yep, that's one thing that I've been saying for months. And honestly, President Xi in China in his speech this morning spoke about free trade. He said he wants free trade. I am a huge supporter of free trade. It has to actually be actual free trade. You know, I've said this for a while. And now I do think that maybe inflation actually will start to come down. But I've said this for a while, and whatever. I don't want to get into politics, so just going to talk about how this affects markets. The Trump tariffs that were put on China and Europe, etc., you can make different arguments for and against them, but one of the negative impacts of them, without a doubt, is that it increases costs and therefore increases inflation. Globalization does the opposite. And right now we are in a deglobalization kind of environment. That's what everyone wants. And you can see that, you know, Trump initiated them, but Biden hasn't taken them away. So that is still something that is kind of going on here. And I understand the importance of things that are strategic, that we need to be able to get our hands on no matter what, that we have to have at least some production ability in the United States. But I don't want my iPhone made in America, man. Because that thing is going to be $5,000. I don't want that, you know. So there's your inflation, right? You make your iPhone in America and it's $4,000 or $5,000 instead of $1,000. Well, that leaves me with less money to be able to buy other things. So yeah. I don't know if it's new, or maybe it's just me that's been saying it for the Fed. The next comment from Mike here was that the Fed can't fix supply side problems. Maybe they haven't said that before. It's something that I've been saying about the Fed here for months, because it's a two-sided thing. It's demand and supply. The Fed can affect demand, which can affect inflation. They can't affect really supply as much, which is the other major factor. It's both that's hitting us. All these people have a ton of money because we printed so much of it, and all of a sudden there's much less goods out there, and that hasn't been able to catch up, especially with the recent China lockdowns even adding on to that even further. So from Eddie here, and I do got to jump into this meeting soon. How does the thesis change on TEL after today? I got stopped out of TEL today. Ooh, I didn't update my... Oops. I forgot to take it off my position disclosure, so I am going to make the disclosure right now. I am no longer in TEL. I announced that during the day. I'll re-announce it right now. I apologize. I forgot to take it off of my position disclosure. I'll make sure that it's not there tomorrow unless I get back into it. I exited. I got stopped out of my tail swing today. I think it ended up being about a break-even trade. I got stopped out on the break of this pivot point right here. As per my game plan for more or less a break-even trade. I'm disappointed. I was excited about this trade. The trade definitely got negatively impacted when they announced that kind of increase of the ability to do a secondary offering for it. But yeah, the trade's dead to me for now. The technicals broke the stock, so I gotta wait for it to kind of reset up at this point. It never should have broken this low here. Now, solid negative Maribozu, close on lows, below the 21 EMA. You do want to see if 5 can hold. You want to see if this pivot low at 444 can hold. But for the time being, it broke down. I'm out of the way. From Robbie, please explain the TLT and stock price interaction and how to use it in trade choices. Sure. So Robbie, we chatted on this already a little bit. Maybe you wrote the question before, because one of the things I was talking about was that it's a constantly evolving kind of thing. It's not always the exact same all the time. So I mean, very broadly, higher interest rates bad for tech, good for value, good for banks. But it's very broad because it's more nuanced than that. It also has to do with the yield curve, right? A common question I've been getting is, Derrick, how come banks haven't been performing with bonds going up so much? Is because the yield curve has been flattening as bonds have moved up. So yield curve's been flattening as bonds have moved down, interest rates have moved up. So higher interest rates generally good for bonds. I mean, generally, I can't even speak anymore. Generally good for financials, but not if the yield curve is actually flattening. So this is where you start to get into some of those nuances. And, the movement of TLT happening too fast tends to have a destabilizing effect. So you might think like, oh, if the TLT started just ripping up, that's going to be good for tech. Not necessarily, because sometimes TLT is a fear trade. When people are afraid, they buy gold, guns, treasury bonds, and sell speculative assets like tech. So if all of a sudden treasuries start ripping higher, that means interest rates are going down. That in theory should be good for tech, but not if it's a fear trade. If it's a fear trade, it's actually bad for tech, right? So again, those are kind of your nuances on how it trades. So we pay attention to these things, but you also have to look at the other factors to kind of figure out how it's going to affect it. So like in a lot of ways, the best thing that could happen to the equity market right now, I think, is actually just stabilization in bonds. Stabilization with maybe a slight upward grind to it, I think, would actually be the best thing that could happen to equities as far as what the TLT does. If it's a very fast up move very quickly, I actually don't think that's going to be good for stocks because it's representative of a fear trade. If it's moving down like it's been moving down, it's going to tend to be bad for tech and not necessarily good for banks because it could be, coupled with a flattening yield curve or a yield curve inversion. So, it's kind of how things generally work, and then they don't work that way sometimes for these other certain reasons. So it's something that we're always kind of talking about. All right, I've got to jump here. It looks like I mainly covered everything. I got to jump into my 5 o'clock team meeting with Pat and Josh and Colin that we do at Thursdays at 5. And Amy, I don't think you guys know Amy. And Pete, I'm not sure if you guys know Pete. I got to jump into the meeting with them. I'm already late, and I'm the one who hosts it. So probably not too good to be late for your own party. Have a great night, everybody. I will see you all tomorrow. We'll assess this price action again and do our best to figure it out because it has been tricky.